Okay, right. We're ready. Good morning, everybody. Welcome to this morning's session. This is a hybrid session, so it is being recorded and there are people online as well. Just for the onliners, please can you let me know you can hear and see okay? Thank you, by using the raise hand function. Yeah, giving me a wave, amazing, thank you. Perfect, that's good. It's just good to know, otherwise you feel like you're talking to a black hole. Don't actually know anybody's there. For people in the room and the onliners, can you please hold your questions to the end? That'd be great, so that Mark and Kate can get through the presentation and we'll take questions at the end. Online people, you can use a Q&A box. You can also use the chat function. So I will be online in the background as well, managing all of those. This will work. So I think without further ado, I will hand over to Mark and Kate. Thank you both very much for coming in this morning. Teach us everything about that we need to know in 1 hour. You'll be done.
No pressure.
No pressure. Okay. So yeah. Thank you. I'll hand over to you guys. Oh, sorry, just a little bit of housekeeping. No planned fire alarms. If the fire alarm goes off, I'll come and get you. Just follow me out the building. And we convene down by. We will convene by the co-op, and toilets are just pop through past the kitchen, legs on the left, gents on the right. Okay, so over to you guys.
Morning everyone, thanks for coming and joining us to talk about the wonderful world of VAT. Whoever said it was a simple tax was telling everyone why, because I think Mark's been doing this 20 plus years and probably still to know everything.
Shows.
So we're just going to dip our toe very shallowly into VAT this morning. We don't want to bamboozle you with lots of technical information, so it very much is an introduction to that. Requirements of when you have to register, if you have to register, can you even register, and then a little bit about some of the schemes if you are already registered. So just an introduction to who we are and what we do as part of Customs and Excise. So Mark and I both work for Customs and Excise in our legislation, policy and advice team. So our team is responsible for, if any of you ring up and ask us a question, we would be the people who would deal with your questions. There's no silly questions in terms of, if you really don't know, please ring us because that's what we're there to do. Technology already. And Mark is our inquiries officer, so for inquiries, the other part of our team deal with our VAT legislation, and they deal with sanctions as well for the island. So Customs and Excise, a little bit about what we actually do. So we are here to collect revenue in terms of VAT, Customs and Excise duty for the Isle of Man. That's all done by a revenue sharing agreement with HMRC. So I don't know whether some of you have seen a couple of years ago, there was a household survey about actually how much VAT you incurred as part of your day-to-day life. That's part of the calculation for us here on the island as to how much money comes back to us for individuals as part of our government budget to live and to run the island. So what we do in terms of our VAT collection is important because the vast majority of government's budget is made up of Customs and Excise duty that's raised on the island. So a little bit about this morning, we're just going to go through some very basic VAT liabilities. We're not going to in any means cover hardly any of the information that you get into in the in-depth of VAT liability because it's very complicated. We'll just go through a little bit about VAT returns, VAT invoices, and a couple of the smaller schemes and when you can and can't recover VAT. So hopefully it'll just give you a taste of it if you don't know anything about that, or if you're doing it and you're not sure. It might answer some of the questions. If not, again, come and see us at Customs, give us a call, send us an email, or ask us at the end. That's fine. So I'm going to hand it to Mark, and you want to start with you.
Okay, so morning everybody. So what is VAT? Basically, it's a tax which is applied to all goods and services that are sold. They have to be sold in the Isle of Man or the UK by what we call a taxable person. I'll explain that in a minute. It's got to be done in the furtherance of business. It's not got to be specifically exempted by the VAT Act. So the VAT Act says that everything you buy or sell standard rated for VAT. Currently that's at 20%. But there's always exceptions. reduced rate, zero rate, and exempt from VAT. They're defined in different schedules within the VAT Act. Don't expect you to get to know the VAT Act or even where everything is, but it's just to be aware that there are documents that actually identify specifically things which aren't liable at 20%. So there are different types of supplies for VAT purposes, and these basically are anything you sell. It's either a supply of goods or it's a supply of services, or it could be a combination of both. So there are two types of supplies. There are taxable supplies and there are non-taxable supplies. I'll talk a little about non-taxable supplies in a minute. Taxable supplies, anybody making taxable supplies has an entitlement to register for VAT. Yes, I'm sure you're all aware that there's a VAT threshold, but that threshold doesn't mean you have to cross it and then you become registered. Anybody who's making taxable supplies can. And there are three different rates of taxable supplies: standard rate, the reduced rate, and zero rated. Even if you only make zero rated supplies, you're still entitled to become registered. But more importantly, from your side of things, you're also entitled then to recover VAT on any of your expenses. So things like your electricity, your telephone, the office rent, whatever. And we also mentioned non-taxable supplies. There are two types. There are those items which are specifically exempted from VAT. That doesn't entitle you to become registered. So if all you do is exempt from that, you can't register. It doesn't matter what your turnover is. And there's another area called outside the scope. That basically means that what you're doing is you're selling goods or services outside of the Isle of Man and UK, so that outside the scope of VAT. I don't expect too many of you will get involved in that area, but it's another area just to be aware of. So, mentioned the different rates of VAT, so what do they tell us? Well, basically, as I've already said, all goods and services that are sold in the Isle of Man or UK are standard rated, unless the VAT Act says something otherwise. So if we look at the reduced rate, this covers a whole range of things, but including some of those items. I'm sure you're all aware about the 5% rate for home improvements, holiday accommodation. On the Isle of Man, it's been 5% for over 25 years. Energy savings, things like specific types of insulation, solar panels. There's a small range of items, and they're all covered in a very specific notice. There are a lot of notices, I will come to them a bit later. There's also fuel and power, so your electric bill, your gas bill, if it's at home, you'll see that it's at 5%. So if we look at the zero rate, there's lots of things that we're aware of that are zero rated. Food, obviously, newspapers and books. If you go and buy a brand new house that's been built, that is actually zero rated. That's what entitles the builder to a claim on his VAT on any building materials or services that he's received. Transport, so you get on the bus, or get on a plane or a boat, you don't pay VAT. Well, you do, but it's a zero rate. And PPE, over the last year, we've all been aware of certain things that have been going around, and we want to buy face masks for a period of time. Government zero rated the sale of face masks. But PPE is generally personal protective equipment. So if you work on a building site, it's a hard hat, steel toe cap, boots or shoes that you get. They're all covered under this.
So you have to sit like that.
Morning.
So we're just thinking at the back.
Just going through the VAT rates at the moment, so join the exciting time. The other area we mentioned were things which are specifically exempt from VAT. So as you know, if you buy insurance for your car, your house, you don't pay VAT on it, it's exempt from VAT. Health, welfare, finance. A lot of finance is also exempt, so you don't pay VAT on bank charges, anything like that. If you buy land or property, they're exempt from VAT. The exception being when it's a brand new house that you buy at 0 rate. Normally, if you buy a house, once it's been lived in, there's no VAT issue, it's exempt. So it means if you're buying and selling second-hand houses, you're not involved in VAT. Betting and gaming, burials and cremations. As I say, it's not an exhaustive list and none of them are. If you look at the VAT schedules, that's where you find the full list of them. So I'll hand over now to Kate. Through what taxable business.
In terms of VAT legislation, we talk a lot about taxable people, taxable rates of VAT. So a taxable person can actually be anyone. It could be you if you're a sole trader. And as a sole trader, it's important to remember that if you do multiple business activities, if you register for VAT, all of those activities would fall under it if it's in furtherance of business, if you're a partnership, if you're a limited company, if you're a limited liability partnership, if you're a club, there's various different legal entities, but effectively a taxable person is anyone, it's any type of entity who is making taxable supplies for business purposes, and it's whether you're required to register. And Mark mentioned earlier about the furtherance of business. So what we mean by that is, say for example, I had a car, I decided I don't want my car anymore because I want to get a new one. If I sold that, purposely went out and bought cars to do or to sell on, and I did that on a frequent basis, that would be business. So it's just looking at how often do you do this. There's lots of actual VAT cases, tribunal cases, and there's some information in the VAT manuals about what is a business and what isn't a business. That's something that we need to help you look at if you're not sure as well. And you're a taxable person once you either become VAT registered, whether you voluntarily want to, or you are required to be registered, which we're just going to watch a little video about what the difference is and when you come over. Sorry, we've got how that works first. So just a little example for anyone who isn't sure in terms of how that actually works. So if you were a business and you were making furniture, if you were VAT registered, you'd make that furniture and sell it with VAT charged on. So in our example, it's £20 for this table and you've charged £4 VAT. But to make that table, you have to buy materials. So you've bought some wood and you've bought some screws to put it all together. So you've paid down £3 to your suppliers in VAT. So £4 you've charged to your customer, £3 you've been charged by your supplier. So the net effect is £1. So if you were VAT registered business, you could recover your purchases, which is the red figure, and you'd have to pay us your output tax, but actually the net effect of that is £1. So if you were VAT registered, you wouldn't have the £4 VAT on the top, but you would have suffered £3 worth of input tax that you wouldn't be able to recover. So it's considering, is it beneficial for me? That's unfortunately something we can't help you with. We're not allowed to advise you, but as a business, it's something to consider as to how much input tax do I lose by not being VAT registered, and is it worthwhile to do? So we're just going to watch a little video, which hopefully is going to magically make it here. And this is just about when you're required to register for that, or if you when you can, basically.
It's actually the first time we've tried to do anything like this, so.
You don't have to click on it, do you?
I think because we've got online people, so Rebecca's going to do it in the background thing to make sure that they can see it.
Oh, she said that. Oh, so much.
Oh, we're at the video.
Sorry.
There's a video slide. Sorry, the video slide. Sorry.
Sorry,
Honestly.
The video is actually an HMRC video, but everything it says, well, pretty much everything it says, applies.
There's a little bit at the end where it talks about HMRC have gone to make the tax digital, so that's where people actually have to have their records available for online HMRC. We've gone to online returns, but don't have to do any, you don't have to use an accountancy package. You can still very much keep your records in paper if you wish to, so don't worry about what's about making tax digital, it's not, it doesn't apply to
Good.
you now.
Oh,
I like it.
no.
Oh,
Good old
it's
IT.
go well.
Or turnover of your business goes over the threshold. If the taxable turnover of your business goes over the threshold, if the taxable turnover of your business goes over the threshold, you will need to register for value-added tax or VAT.
Oh, it's very smooth this, isn't it? I'm so sorry.
Jane, is a share screen thing on Zoom?
Thing. Yeah, I thought I'd turn it on.
It's not play it, I think sound should be enough, everyone can cope with that.
Screen share, please. Just doesn't seem to want to go off that.
Just play
Yeah.
it, just
Try it.
Just play it.
Just get rid of that. There we go.
Oh,
There we go. Smooth that. I'll have to work that one out.
If the taxable turnover of your business goes over the threshold, you will need to register for value-added tax or VAT. Taxable turnover is the total value of everything you sell which isn't VAT exempt or where VAT doesn't apply. Remember, you can only charge VAT if you are registered for it. More information about VAT registration is available on Gov.uk. There are other reasons why you need to register too. If your business is based outside the UK, but you sell your goods or services in the UK, you should register straight away, as the threshold doesn't apply to you. If your business is already over the threshold and you haven't yet registered, you should register within 30 days of going over. If you're taking over a business which is already or should be paying VAT, you'll also need to register. You can also register voluntarily for VAT, even if the taxable turnover of your business is below the threshold, but you will have to keep accounts and file returns to HMRC. If you don't register on time and are over the threshold, you'll have to pay the VAT due and you may be charged a penalty. You should check your taxable turnover every 30 days to see if you've gone over the 12-month threshold. You'll need to keep digital records and submit your VAT return using Making Tax Digital compatible software. If you're not over the threshold, you don't have to use this software. There's more about Making Tax Digital on gov.uk.
So as we said with that, making tax digital is a try on the one, so you don't need to worry about that. One area that's worth pointing out, because sometimes people do get confused, is when they talk about the 12-month period, it's not your financial year or calendar year, it's a rolling calendar period. So it's something that you need to check, like you said, every 30 days to make sure that in those last 12 months you haven't gone over the threshold. So if you're getting close to it, it is worthwhile really keeping a close eye on it, because it's quite easy to slip over, like the video said. When you're required to be registered, you have to pay back to that date. So if you, for a couple of months, a year, 10 years in some cases, as we've seen, late registering, there's no limit for how far that goes back. So it is really important that people do check that. We don't want people to be in a position where they've got thousands and thousands of pounds to pay in backdated VAT. So that is a good tip to take. Mark's going to talk about if you become VAT registered or if you are registered, what your VAT invoices need to include.
So VAT invoices. Okay. So I'm sure you've all received VAT invoices from people in the past. You've probably not looked at them that carefully unless you are VAT registered. But there's some key information which must be put on an invoice for it to be a proper VAT invoice. So the most important thing is the supplier's name, address, and VAT number. They should be clearly identifiable, along with an invoice date. There also needs to be some sort of a unique reference number, because invoices should be sequentially issued, so we can see that everything that's been raised has actually been brought to account. You also need your customer's details, their name and their address. On this, it actually shows their VAT number as well, but that's not essential. Another important area is a description of the goods, and if there's multiple items, if there's a unit price as well, so we can see how the amount has been generated. And most importantly, we need to show the total amount of VAT being charged. Now, if, for example, you get that amount wrong and you put too much or too little, your customer can only claim back the amount that's shown on this invoice.
And if you're VAT registered, you have to pay us what's on your VAT invoice as well. So if you accidentally calculate that's too much, even if it's wrong at the time of the VAT return, you have to pay us what's on there. The other thing to mention probably on that is must
be in sterling. If you issue an invoice in another currency, euros or dollars, you have to show a sterling equivalent. Otherwise, it could be open to exchange rate fluctuation. There have been cases in the past where people have used that fluctuation to actually gain the VAT advantage. So, beginning of April this year, we went on to online VAT returns for pretty much everybody. There are some people who've applied and been granted exceptions. But basically, the invoice, the VAT return itself, although it's on screen, it's exactly the same format as the old paper VAT return. Important things that are identified: the actual VAT period. In this case, it's a single month return. The start date is the 1st of January and the end date is the 31st of January. And it still shows the due date as being the 28th of February. So that's the end of the following month. But when online returns first came out a few years ago, people could sign up to it voluntarily. As an incentive, they were given an extra 7 days to submit their VAT return. And that still holds true now, even though it's mandatory to do online returns. So in effect, the end date of your VAT return, you get 30 plus 7 days to submit your VAT return. Payment, also, if you have to pay an amount of tax to us, that needs to be made by the same date. So that would be the 7th of March in this case. That's not a case of you saying, ring the bank and say on the 7th of March, oh, we need to pay a VAT bill. It actually needs to be hitting our account on the 7th. Otherwise, the system will say it's late. So we're covering VAT, we've already mentioned VAT invoices. Your records must show what you bought, who you got it from, how much you paid. So you need the date of the invoice, the supplier's name, the value of the goods that you bought, and importantly the VAT that you were charged. Not necessarily the amount of VAT that should have been charged, but what's on the invoice. So to do all this, keep on saying it, you must have VAT invoice. Importantly, it mustn't be for personal or non-business use. You can't have the VAT back on stuff that you buy for yourself. And try and avoid duplicating entries. You see it all too often. People will put in an invoice and then forget to put it in again. So they're claiming the VAT back on that one purchase twice. It's a bit of a no-no. So let's look at one or two typical expenses. Motoring expenses, most of us have vehicles, most of us use them for work. So we want to claim the VAT back on running that vehicle, the cost of the fuel, the maintenance of the vehicle. When it's a car, you can claim the VAT back, but there are two things that you need to do. You would need to keep a detailed vehicle log of all the mileage that you do. Secondly, you would have to portion the non-business use, private use, against the business use, and only claim back that amount of the tax. Alternatively, you can pay a scale charge. That basically is you pay your fee, you claim all of that back on your fuel. There are set rates, and it depends on, these days, it depends on the CO2 rating on your vehicles. It's a big table listing more on HRC's website. Again, as I mentioned already, all our information we get comes from HRC. That's the reference there for the motoring expenses notice. It's notice 700/64. There are a lot of these notices. They cover very small but specific areas of VAT and things that people do. They help explain what you can and can't claim. So it also goes into things like buying cars. If you buy it outright, if you buy it on HP, if you've got a specific type of car, maybe a taxi or a driving school car, they're specific vehicles that you can claim the VAT back on. Most cars you can't, but there are rules there that tell you what you can do and how you can do it.
And it'll define what they mean by a car and then what they mean by commercial vehicles, such as a van or tipper or anything like that.
So if you're a plumber and you buy a van, that's a commercial vehicle. You can claim your VAT back on the fuel. It's not a car, you have to pay a scale charge. You get all the maintenance back, you claim all the VAT back on it. Again, it's not a car, it's a commercial vehicle. So you're allowed to get the VAT back on it because you're using it in your business. If you use it to go shopping all the time, you can't have the VAT back for that. Another common area, business entertainment. Again, there's the reference to the UK notice. And it covers the rules on what you can and can't recover. So if you want to take your staff out to reward them for a good quarter's work, take them out for a lavish meal, staff, not a problem. You can claim the VAT back on that. If you want to give gifts to staff because they've performed well over the year, spend up to £50, claim the VAT back on the gift. You're not making a taxable supply, but under these rules, you're allowed to claim the VAT back. If you go and buy a Rolex watch, you won't be able to get the VAT back on that because it's over £50. As I say, there's lots of different notices there, but there are also some other areas. Katie's going to talk. Oh no. Sorry. Some common things that people try and claim back, but they're not allowed. So people claim back fuel, they're not paying the scale charge, or they're using the vehicle for personal use, they're not portioning it. Take out potential clients for a meal, you want to impress them. Corporate hospitality, can't claim the VAT back, they're not employees. Again, that's covered in the notice. Clothing, most clothing is taxable, children's clothing isn't, we already mentioned that. But if you go out and buy jackets or things for people who are working, maybe they're going outdoors a lot, just buying them a jacket, can't claim the VAT back. If it's uniform, you've got embroidered polo shirts that everybody's got to wear at work, or if they're going out doing deliveries, they've got to wear some branded clothing as uniform, you can claim the VAT back on that.
I think there was actually a case about clothing where a lawyer claimed that his suit was part of what he needed to do his business every day. And I actually went to tribunal and they said, no, everyone has to wear clothes. What they choose to wear to go to work is up to them and it's not a business expense. So there was actually a ruling on that. So that's rulings are sometimes good for businesses, sometimes good for us, because it really clears up any murky areas where it might be business, it might not be business, but there was a case on that one. So
yeah, he claimed his Savile Row suit was his uniform. New cars, we've mentioned, sometimes people claim the VAT back on new cars. If you look in the motoring notice, it tells you what the rules are for claiming the VAT back. Normally, the VAT is blocked. That's a term you might hear used more, when you get more familiar with VAT. Certain areas, the tax recovery is blocked. You're not allowed to get the tax back. Mention non-business use. So yeah, you've got a business where you maybe, for example, a stockbroker, they'll have a TV screen in their reception area, shows all the markets and what the current exchange rates and things are. That's fine, they can claim the VAT back on that. But if they bought 2 tellies and they put one in their own office or even at home, can't claim that on that because it's not business use. Transport, again, sometimes people mistakenly think there's VAT on transport, so getting your train or your boat or your bus, they think there's VAT on it. They actually claim the VAT back. There's no VAT. So those are the things, some of the common areas that people tend to get wrong. So what I'll do is I'll hand over to Kate now. She's going to talk a little bit about some of the schemes.
So in VAT, the standard way of accounting for VAT is you'd raise your sales invoices, they go into your VAT return, you'd get your purchases who you bought things from, you put them into your VAT return, and we'd either pay you back depending on if you bought more than you sold or depending on the rate of VAT, or you pay us the difference. There are a couple of schemes for smaller businesses which might just help in terms of cash flow, in terms of record keeping. So we'll just go through those in very basic detail. All the notices are at the top of there, so 731 for cash accounting. But again, this is something that if you think, oh, this might be beneficial to me, it's looking at and going, what are the pros and cons? Because they all have pros and cons, and whether it's appropriate for your business. So cash accounting is the opposite of normal accounting for VAT. So as I just mentioned, you'd raise your sales invoice, the date of the sales invoice will dictate what VAT return that needs to go in. You'd buy your supplies from your supplier, the date of the invoice again will dictate which VAT return it needs to go in. You'd have to put that into us and pay regardless of whether your customers have actually paid you for your sales. So if you made lots of 20% sales and they were really high value, but your customer was really slow to pay, you could be out of pocket, your cash flow could suffer because you've got this large amount of that you need to pay to us, you haven't physically received it from anyone. So cash accounting can sometimes help in those situations because you only have to actually account for on your VAT return what you physically been paid. Now that is fine in terms of the sales, but it works the same for purchases if you decide to go to cash accounting. So if you don't pay for your purchases, you can't put them in your VAT return. So it's just weighing up, is it worth it for me, just like my cash flow? So obviously with invoice accounting, bad debt, if you don't get paid, you'd have to do a write-off. There's lots of rules around that when you can. With cash accounting, you don't have to put anything in that you haven't actually been paid while you're using it. Your turnover has to be below 1.35 million. So for us, that's probably quite a big business in the UK. It's a fairly small business. So these are for small business schemes. You don't have to tell us if you want to use cash accounting. You can do that at any point. You just have to keep records that show that you're using cash accounting. So obviously you need to keep a good detailed list of the invoices you've actually raised, what's been paid, when it's been paid, so we can match it to the VAT return. And if for any reason you decided to come off cash accounting or you deregistered, all of those invoices then have to be brought to account at the end. So it is really important, adequate record keeping with cash accounting. And if you are VAT registered, you can't start it in the middle of a period. You just have to make a decision from the next start of the next VAT return, go to cash accounting, and just keep your own records that show that. From that point of view. So the next one I'm going to talk about is annual accounting. So for annual accounting, most people are on quarterly returns. You complete your VAT return every 3 months. Annual accounting only requires you to actually complete one return a year. You get 2 months after the end of the period to file it with us, and you actually make small interim payments during the year towards what you think your VAT liability is going to be. So if you're already registered, we'd use the previous years as a baseline figure of how much you earn. And if you say, well, actually, I've got 5 more customers this year, I think it's going to be more. We have those conversations to say, okay, well, actually, pay us X amount per month for the next 9 months, and then that's most of the balance paid. And then when you submit your VAT return, if you've overpaid, you pay you back, or if you've underpaid, you just settle up the balance. So it can again be useful in terms of cash flow for businesses. And we wouldn't normally tend to see people who are in repayment positions, so construction wouldn't choose to use annual accounting because they'd wait a year for us to refund them probably quite a lot of money. Again, with this one, most people owe 1.35 million. There are upper limits for all of the schemes that you must come off if you reach for VAT for annual accounting and for the cash accounting it's 1.6 million. So again, we don't have that many people on it, but there are a few people who choose to do this because again, you don't have to worry about submitting the VAT return, finding the money every 3 months to do it. But again, it's subject to business whether they think it's useful. And the final one, this is for really quite low turnover businesses. We do have quite a lot of applications for what we call the flat rate scheme. So this is a simplified scheme where, and you'll find that there's a lot of businesses who pay out 20% of that. So catering is a really good one to use as an example. Probably most of the people who we get apply for the scheme are caterers. So if you food is 0 rated, so we go to Tesco, you buy fruit, veg, meat, all 0 rated. But if you were to buy that from a pub or a takeaway, because there's a service element of that, that makes it standard rated for, so if you buy Chinese, if you buy meal, you pay 20% VAT normally. It's a reduced rate at the moment, but normally you pay 20% VAT. But when you think about their VAT return, they're paying 20%, but they've got 0 input tax really, because all of it's 0 rated, so they're not going to have very much VAT recovery. So what the flat rate allows them to do is, instead of having to keep all those purchase records, they just have to keep the sales records, and they pay us a percentage of the sales over. So for catering, it's 12.5% of their total sales, and that accounts for the fact that they don't have any input tax recovery. But it's quite a low value scheme, so you have to be turning over less than 180,000 gross to apply for it. And once you reach 230, you have to come off it, so it's relatively low. Now, this isn't going to suit all businesses, because if you have a large amount of input tax that you can recover, you're not going to be able to do it through this scheme. It doesn't allow you to recover any input tax because it's simplified, so it's considering what are the pros and cons of this, and whether it's worthwhile. And you do have to apply to us for that one as well, which we look through and see if you're already VAT registered, how much your turnover has been, as to whether we think it's going to be applicable for you, or if not, your prediction for the next 12 months as to whether you think it's going to be 150 net or 180 gross. Yeah, so that's the flat rate scheme, can be useful in some cases. So just put here some examples of the VAT notice and guidance. So the best place to probably start is the VAT guide, which is VAT notice 700. It covers vast majority of basic VAT. So you've got in there about what actually is VAT, input tax, output tax, invoices, all of the information that you need to get started. And it does give you basic rules of your liabilities, and also talking around how to treat services, how to treat goods if you bought them from outside the UK or if you're selling them outside the UK. It does give you a good place to start. And then on HMRC's website, you can actually go into the more details about notices, which talks specifically about areas of VAT. So as Mark mentioned earlier, there's a motoring expenses one, and there's one on each of the schemes we've just touched on. Property, there's various different things in there, which are really the more technical guides in terms of everything to do with VAT. And it is worth mentioning that guidance is guidance, and everything that we do goes back to legislation. So there are some grey areas where perhaps guidance is open to interpretation. So probably worth, if you're not sure, or you think I'm not quite sure I've read that properly, give us a call, because we can actually make a ruling on your behalf that says we agree with you that this should be the rate of that. And then that's on us then. If somebody did a visit on your business and said we don't agree with that, that comes back on us, and we don't agree with this decision. So it protects you in some ways from getting things wrong. And that's what we do, that's our job, we're there to help you. And then just finally, so thanks very much for listening, and we'll take any questions now. And just to mention, we're actually in the process of creating more seminars in terms of different areas of VAT. So the two that we've got, which are now open for booking on the market, keeping books and records, that's quite a detailed presentation around the requirements for your records, and actually we came out to basically what we'd expect to see, how you should keep them, what your legal requirements are in some cases. There's some schemes that have force of law that you must keep certain records, and they can cause quite a lot of bother if you don't. So it just goes into a little bit more depth around what you're required to do, and filling in your VAT return, which again goes into more detail around what you must put in each of the boxes, and how, if you make any errors, how to correct them. And there's more seminars coming once Mike and his colleague Mark create the contents, but I think we're going to be looking around input tax recovery in more detail, margin scheme, which is used for second-hand car dealers or antiques, businesses, and around the specifics of that, because that commonly causes quite a few problems. So we will be updating our website, and we will be contacting people if they come back registered to say these are the seminars we've got available. But if anyone is interested in anything, customers@gov.im is our email, just drop us a line, and we'd be quite happy to help you. So yeah, if anyone's got any questions, we can take them now.
I've got one. So say you filed your quarterly VAT return, which is, and one of your clients turns out to be a bad debt. So I paid over what I should do to you guys, but at the end of the day, I don't get either my own income or that VAT. Can you claim, is there a way of claiming it back?
Yeah.
Right,
So,
sorry, is there a way of claiming the VAT out back from you guys?
yeah, so bad debt relief kicks in. So if you raise an invoice and your payment terms for 30 days or 7 days, 6 months from that payment date, you can recover any VAT that's not been paid to you. You need to keep it in your records that you've put it through as bad debt, because if a year down the line they said, oh, I haven't paid you, here it is, you then have to readjust for that. And if you did get paid for VAT, but six months is your general rule after your payment due date. And you can only go back 4 years.
There is a notice on bad debt.
Yeah.
Surprisingly.
I've just got 2 or 3 little questions which have just popped up. You mentioned on new cars they were blocked or non-deductible. How's that work for commercial vehicles?
Right, commercial vehicles are not cars. It is differentiated in the notice what qualifies as a commercial vehicle. Buy a commercial vehicle, you can claim the VAT back on it. There's no block, no restriction. If you buy a car, there are restrictions on what cars are eligible for full recovery. So I mentioned taxis, learning to drive school type cars. If you buy a vehicle which is going to be held exclusively, and it says that in bold in the notice, for business use, i.e. it's not attributed to any single member of staff.
They can't take it home.
It's not kept at home, it's garaged at the office address, the business address, the offices, and the keys are there for anybody to, within the business, to come and take the car and use it. You can have that is a business car, it's like a pool car, if you like. Another common business which can claim that back on vehicles, hire cars. They aren't used for personal use, they're just hire, they're making taxable supplies to those vehicles.
So I think the notice goes into quite a lot of detail around the definition is it's to do with the payload of the vehicle, the style and the seats. It goes into quite a lot of detail as to, because I know probably 4x4s become quite a grey area sometimes, but if you are buying something with a vehicle for a business, it will be worth consulting that, having a chat with us to say where does it fit. And
All right. Next one, somebody touched on briefly outside of the scope of VAT.
Right.
I already am VAT registered. Part of my business pre-COVID, I'd go and work away in the Arctic.
Right.
And I inquired when I was setting that up, how I would operate that for VAT. And they told me at the time because the supply was outside, blah, blah, but it was classes outside school. And subsequently, I put that on the invoices and not charge that. Obviously, with the current situation, that's on hold anyway. But with in between times, we've left the EU, etc. Does that make any difference? Or so when I resume, are the rules still the same? There's still classes outside the school?
Yeah. In, if you like, pre-Brexit, everything outside Europe was outside the scope. Now that we've left Europe, everywhere is outside the scope. So in some ways, it's perhaps made it easier because we don't have to worry about that European thing anymore. Europe is just effectively another country outside the UK.
Sorry, I was trying to do all lots of questions here, but maybe somebody.
That's all right.
What is the situation with medicinal pharmaceutical supplies? I'm thinking in particular the new cannabis industry. If one becomes licensed,
Right.
what's the
Probably
implications then?
a conversation for outside of here, because
Quite a specialised area.
specialised, and we assume it's going to be standard rated. But then obviously you go into export licenses and various different places, probably a conversation outside. Because it's not something that we've got clarity on yet either.
So it's just still early days. There you go. I mean, obviously film production, some of it's classed as a discount, which you could assume there would be data. But then there'd be health and beauty.
So it's
limitations, so
very
gonna cost a lot of-
detailed about what qualifies as medicinal. Any of the healthcare, any of the prescription. There's well, the notice is humongous on terms of what it actually means, who's providing it,
Who's actually
Yeah.
administering
who's administered it,
the medicine.
who's approved it, what sort of trial. So it's a big area out, so it's probably quite complex, and we need to research more on
This might be a trying to oversimplify, but if you're selling it off Ireland, does that take it outside of scope?
Well, outside the UK.
Yeah.
Then yes,
Right.
but then if you're selling physical goods outside of the UK, they're exports. So then there's a whole different set of rules, because obviously certain goods need export licenses. So if you're selling firearms or weapons or military type material, that may need export licenses in order for you to actually get to the point of trying to make a sale. They're all controlled by the UK. You remember the huge pipes in, I think it was Hull or Grimsby, years and years ago. They were getting ready to sell them, so they manufactured them, and the MOD turned around and said they're dual use goods, they could be turned into a super gun. They weren't allowed to sell or export. Around the time of the Iraq War.
Mark, sorry, can I go to a couple of your
Yes.
questions? Is that all right? Got 3 questions online. One from Emma is, if you don't sell that, can you still claim that back for expenses?
If you don't sell,
So if you're not VAT registered.
Yeah.
If you're not VAT registered, you're not entitled to charge or recover any VAT.
Okay. Oh, brilliant, was it? It's just a question. Okay, we'll go to an in-room question.
If you're a small business who's not yet registered and you do register, is there any backdated type area?
there is pre-registration expenses. There are things that you maybe capital goods, maybe you buy a vehicle that you can run your business from, and you're using that for business purposes, and then 3 or 4 months later you become VAT registered, you can claim the VAT back on that vehicle because you're using it exclusively for the business. If you're buying materials, then there's what we call stock on hand. So if you're you're a builder, you buy 100 bricks, you build somebody's brick wall and you use 40 bricks, and then you become VAT registered, you can claim the VAT back on the 60 bricks that you've still got left.
What about tools? So
Tools, tools and equipment. Yeah, if you're a builder or a plumber or an electrician, obviously you've got an array of tools that you need. If you bought tools and you've got them, you've still got them, by the time you become VAT registered, as long as you've got the VAT invoice,
Yeah.
you can claim the VAT back. Goods, you can go back up to 4 years prior to becoming VAT registered. So if you've been running your own business for 2 or 3 years and you kitted out a shop and bought a till and you've got all sorts of shelving and lighting set in that shop, and 3 years down the line, you actually hit the VAT threshold, you can still claim back all the cost on those elements that you've still got on hand. So all the assets, all the equipment, all the tools that you've got, and if you had stock and you've still got some of those items on hand, pay that back on that as well.
So when you talk about stock, so part of my business is retail, so I obviously, I'm not that registered, so I'll obviously not be charging that to my business only a year old. So I've still got some stock, but obviously I've sold a lot of stock over the year.
Yeah.
So I can potentially.
And anything that you've sold, we can't collect that on, but you can't collect that on.
Okay,
Okay,
So anything you've still physically got,
yeah, okay.
you can.
you can claim the
you
VAT
file
back
that invoice, you can
because-
claim that.
once you're registered. When you sell that, you'll have to charge that,
Yeah, exactly.
unless of course it's one of those rare items which is exempted from VAT, in which case you can never claim the VAT back on that. That's a whole different subject. Definitely not one for today.
Just picking up on the bad debt query earlier on.
Yeah.
I'm trying to picture how that would look in a quarterly return. So 6 months down the line, somebody hasn't paid you, let's say it's £1,000. And they owe you 1,200 quid. So it goes back to where, it goes back to say March time. What would you be, how would that be? I mean, obviously from a debtor point of view, you'll still show it as a debt in your own books.
Yeah.
But from a
VAT.
Yeah, what do you expect to see on the?
So we see quite a lot of people who raise credit notes, that's the wrong thing to do. If it's genuinely a debt that's owed to you, don't raise a credit note. It should go through box 4 of your VAT return. So you don't put it into box 7 as a purchase, because it's not, it just goes through box 4 as an adjustment. And then if we ask any questions, as long as you can identify it's this invoice or these invoices, this is when they should be paid, we haven't received the money for them, that's fine.
Fine. And would you want, well, of course, you probably can't online directly, but should a person include?
You don't have to.
Unless you guys come back.
Only if it was a large invoice, that's gonna obviously put out your VAT return to make it look really unusual that you're reclaiming, say, £10,000 where normally you're not in that position. It might be worth just dropping us an email with the copies of the invoices and to say, I've wrote these up as bad debt, and we put it on your record.
Sure.
As a general tip for anybody who's VAT registered, if you're going to be claiming back an unusually large sum of VAT for you, even if the actual VAT return is a payment return, it might still get brought up in queries. So let's say, for example, you've got a farm, you buy a new tractor. Tractors are very expensive, have a lot of VAT on them, and farmers want to get the VAT back. When they put their VAT return in, they're claiming their £5,000–6,000 VAT for their new tractor. It's always a good idea just to follow up with that return with an email and a copy of the invoices that created that unusual situation. In a few words, they might answer all the questions that we can ask before we ask them. And so it just means that the processing of that repayment is just done so much quicker for you and for us.
Question here online, going back to the pre-registration expenses, would you have to copy all the relevant documents to reclaim the VAT, potentially 4 years worth?
You wouldn't have to provide them to us. We might query some of the expenses, but you wouldn't have to actually provide the documents. Sometimes if you've got a schedule of all pre-registration expenses, that might be more than sufficient.
You must have them, you must have the invoices to them.
Yeah.
If you don't have the invoice, you can't claim them back. So that's the most important.
But then if they're big items, if you've lost the invoice, you may be able to go back to the original supplier and they may provide you a copy.
Great, Vicky, hopefully that's answered that for you. I have one other here. If you buy from the UK, but the goods are produced in Italy and you have obtained the IORI number as it will be delivered and used in the Isle of Man for VAT purposes, how is this treated on the VAT form?
That depends on whether or not it becomes an import. So if the value of the goods are over £135, that will then need to be treated as an import for VAT purposes. So that would have to be entered when it arrives in the UK, it needs to be an import entry, and you have to pay that and any duty that's applicable at the time of importation. If the goods are less than £135, then the supplier in Italy should actually have a UK VAT number, and they would charge you an account for the VAT at the time that you buy it, in which case you would have a proper VAT invoice and just be as any other normal invoice.
Great, thank you, Mark. Angela, hopefully that's answered that for you. So I have there.
So that last example you gave, it's despite the fact that this was not, we're
Sorry,
not in the EU anymore.
no, these are rules, if you like, that I think they came into force beginning of July.
Okay.
And it's really looking at finding the best way of treating. We used to buy things in the post and get them posted, and the low value goods, and there was a thing called low value consignment relief, and that applied generally to small value purchases. So if you buy a couple of CDs or maybe an LP or something, buy it over the internet, there was no VAT. No import aspect, but it came in from outside the UK. So that covered all of Europe and everywhere else. After we left the EU, that created an issue because we had lots of people still buying goods in France, Germany, Italy. They're still in this low value area, but the LVCR fell away when we left the EU. And so this is kind of a way of replacing that, and it gives everybody a more level playing field so that the suppliers know when they need to account for VAT. In other words, if they're in France, if they're supplying lots of things that are valued under £135, they're going to have to apply and register for that in the UK. Same would go for somebody in the UK who's supplying people in EU countries. They would need to register for EU VAT. It's starting to get a bit complicated there, so.
But if it's over £135,
£135 is that level, and anything over that has got to be imported properly.
And that will go from a personal level as well. So if anyone bought any things, personal items that have come in from outside the UK, you might get a letter from us saying VAT is due on the import, and you need to pay it before convenience from the post office. So it's exactly the same principle for a business. But with a business, they get issued formal paperwork, which gives them the entitlement cover for VAT and for business purposes. So it's the same process, just a slightly different paperwork that's produced.
Business or personal, you need the IORI number. That's gazoling on our website, which takes you to the UK area where you apply for IORI numbers. So if you're in business, if you're VAT registered, your IORI number, if you've not had one before, will be tied into your VAT number. If you're not in business or not VAT registered, you will get an IORI number, but it may or may not have anything to do with a VAT number that you might get in the future.
Just conscious of time, just
Right.
one more. I've got one quick question on here and then one more from the floor.
Yeah.
You go first.
Yeah, if you're a service
based business with very little outgoing expenses, would you be looking at a flat rate? And is the threshold still the same as being required to register?
But that threshold doesn't change. It's 85,000 regardless of what you do or where you do it. In terms of the flat rate scheme, if you've got very low expenses and you're mainly service based, then it would be likely that you would be able to use the flat rate scheme, but you probably have to use the higher charge, which I think is 16.5%. Because you've got very little input tax normally. The difference between the standard rate and the rate that you would pay is reduced. That helps.
One final quick question. The lady just clarified that the one said if you don't sell that. So basically, if you're selling a non-vatable product like fish, I believe it's non-vatable.
So it's zero.
Zero rated, sorry, yeah. Do you on that, but you still pay fuel and your expenses to go fishing? Do you claim the VAT back on the expenses?
So this is where we talked about the VAT rate, so positive rates of VAT, even though it's zero, so you don't effectively charge any VAT, it's still a VATable supply, so you are entitled to recover any costs that relate to your business.
Right. Emma, hopefully that's answered that for you. Just very conscious of time. I'm sure that Mark and Kate won't mind, obviously their contact details are on the screen, so if you've got any other questions, I'm afraid you've given out your email address now, so that's
Well,
that.
yeah, I've got business cards there, I'm going to go once to grab one.
So if anyone has any other questions, thoughts following this morning, please do. Is it okay to share the slides?
Yeah.
Yeah, so I'll share the slides and the recording for this session. So, you know, if there's things you've forgotten or you want to re-watch, then you can do that. Sorry about the technical issues. I was really hoping we were going to nail that. But
All best laid plans.
these things happen. Thank you very much, both of you, for coming in this morning. And thanks everyone for attending. I hope you found that useful. And yeah, we'll speak to you soon.
Day 16 last night now.